receivable over net credit sales times 365. Days sales outstanding, average accounts receivable over net credit sales times 365. Days sales outstanding, average accounts receivable over net credit sales times 365. Days sales outstanding, ending accounts receivable over net credit sales times 365. Days sales outstanding, ending accounts receivable over net credit sales times 365. Days sales outstanding, 365 over accounts receivable turnover. Days sales outstanding, 365 over accounts receivable turnover. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, ending inventory over cost of goods sold times 365. Days inventory outstanding, ending inventory over cost of goods sold times 365.
All right, welcome again. Today is Monday. It's time to go ahead and study. Let's go ahead and do it. Father God, we thank you for this beautiful day, Monday. Thank you for giving us the opportunity to be back again to study. Lord, we ask you for knowledge. We ask you for understanding, wisdom, and intelligence that comes from you. Forgive our sins, we pray in Jesus' name. Amen. Amen. All right, so let's get started. Let's get started today again. Okay. Currently studying trade receivables. I want you to give me the foundational knowledge that I need to understand and master this chapter, trade receivables. Trade receivables is not about memorizing journal entries. It is about understanding one big idea. The company has sold goods or services on credit, but has not collected the cash yet. Everything in this chapter builds from that one sentence. Okay? Foundation 1. What is the trade receivable? A trade receivable is money customers owe the company because the company sold its normal products or services on credit. Sell today, cash later. Example, sell inventory today for $10,000. Customer pays in 30 days. Journal entry, debit, accounts receivable $10,000. Credit, Sales revenue $10,000. No cash has been received yet. Foundation 2. Two types of trade receivables. Okay. Foundation 2, there are two types of trade receivable. There are two types of trade receivables. Accounts receivable, that's the first one. The most common one, okay, no written promise, usually due in 30 to 90 days. Current asset. All right, so accounts receivable is current asset. Example, we'll pay you in 30 days. The second one is notes receivable. Notes receivable. A formal written promise includes principal, interest, due date. Example, I promise to pay $20,000 plus 8% interest in 6 months. Remember, accounts receivable equals informal. Notes receivable equals formal. Foundation 3. Receivables are assets. Why? Because they will become cash. Balance sheet, current assets, cash, accounts receivable, notes receivable, inventory. These are current assets. Foundation 4. Net realizable value. Very important. Net realizable value. This is the biggest concept. The company knows not every customer will pay. Therefore, accounts receivable is not reported at its full balance. Instead, accounts receivable minus allowance for credit losses equals net realizable value. The formula, accounts receivable minus allowance equals net receivable, or net receivable equals accounts receivable minus allowance. Okay. Foundation 5. Allowance for credit losses. Ask yourself, how much do we expect not to collect? This is allowance for credit loss. How much do we expect not to collect? That estimate becomes the allowance. The allowance is contra asset credit balance. The allowance is contra asset credit balance. Normal balance is credit. Foundation 6. Current expected credit loss. Current expected credit loss. Modern accounting says estimate future losses before they happen. Old thinking, wait until customers stop paying. New thinking, estimate expected losses today. Example, accounts receivable $200,000, expected loss $8,000. Okay. Foundation 7, writing off an account. Writing off an account. Eventually, you know this customer will never pay. Now remove that customer's balance. Entry your debit allowance for credit loss. Allowance for credit loss will go down. Your credit accounts receivable. Notice no expense. Why? Because the expense was already recorded in earlier under current expected credit loss. This is one of the CPA's favorite questions. Write-off does not reduce net income. Write-off does not create a new expense. It only removes accounts receivable allowance. Both decrease. Accounts receivable and allowance, both of them decrease. Net receivable stays exactly the same. Net receivable stays exactly the same. Foundation 8, recoveries. Sometimes customer pays after being written off. 2 steps. First, reverse the write-off. Debit accounts receivable, credit allowance, then collect the cash. Debit cash, credit accounts receivable. Foundation 9. We need to explain that a little more. Foundation 9. Receivable turnover. This measures how quickly customers pay. The formula is receivable turnover equals net credit sales divided by average accounts receivable. Higher is usually better. Foundation 10. Days sales outstanding. This tells how many days it takes to collect. Days sales outstanding. The formula is days sales outstanding equals 365 divided by receivable turnover, or average accounts receivable divided by net credit sales times 365. Lower is usually better. Foundation 11. Sales discounts. Example. All right. So let me see. We have bad debt expense. Bad debt expense answers how much loss do we expect, not who failed to pay. That's why expense comes first. Write-off comes later. We have the matching principle. Revenue and expected losses belong together. If sales happen this year, expected bad debt belongs this year, not next year. Okay. The matching principle. Revenue and expected losses belong together. If sales happen this year, expected bad debts belong this year, not next year. That is why we estimate losses immediately. All right. What changes net income? Know this code. What changes net income? Increases expense. Recording expected credit loss. Recording expected credit loss. Net income decreases. Does not affect net income. Writing off account. Recovering account. Collecting cash. Does not affect net income. Foundation 15. The CPA exam logic. Whenever you see a receivable question, ask these 5 questions in order. Did we make a sale? Record accounts receivable. Are we estimating future losses? Record credit loss expense and allowance. Is this customer definitely uncollectible? Write off using the allowance. Did they expectedly pay later? Did they unexpectedly pay later? Reverse the write-off, then collect cash. Are they asking for a net receivable value? Accounts receivable minus allowance. The mental map. There is a sale. The sale creates accounts receivable. You estimate your losses, current estimated credit loss, and then you have the allowance for credit losses. You have the net realizable value. You have customer pays or customer defaults. You write off, and then possible recovery in the future. Okay. All right. Recognition. Record the receivable when credit sale occurs. Valuation. Report receivables at net realizable value using the allowance for credit losses. Collection. Receiving cash reduces accounts receivable. It does not create new revenue. Collection does not create new revenue. Write-offs and recoveries. Write-offs use the allowance and do not affect net income because the expected loss was recognized earlier. All right. I think there are a few more things that I need to clarify. Okay, what is a trade receivable? Trade receivable is when you sell on credit and customers have not paid you yet. Okay. Two type of receivable. Notes receivable, formal written promise. All right. Can we create a keyword list? That means when you see this, it is talking about this. When you see this, it's talking about this. When you see trade receivable, think money customers owe you from normal sales. Accounts receivable, credit sales, no written promise. Notes receivable, written promise to pay usually includes interest. Net realizable value, accounts receivable minus allowance for credit losses. Allowance for credit losses, estimated amount that won't be collected. Contra asset, credit loss expense or bad debt expense. The estimate of future uncollectible accounts reduces net income. Current estimated credit loss. Estimate expected loss now before customers default. Write-off, remove an account that is known to be uncollectible, no new expense. Recovery, a customer pays after being written off, reverse the write-off, then collect cash. Contra asset. All right, let's get to work. It's 14 minutes in doing that. Let's go for 10. Okay. During the year, the company wrote off a customer's account receivable. The company recognizes credit losses according to the current expected credit loss model. What impact would the write-off have on net income and total assets? Wait, okay. Net income, total assets. During the year, the company wrote off a customer's account receivable. The company recognizes credit losses according to the current expected credit loss model. What impact would the write-off have on net income and total assets? Net income, no effect. Write-off doesn't have no effect on net income. We just read this. What about total assets? Total asset would decrease. Write-off, yes, if you write off something, it's coming out of your accounts receivable. That means it would decrease your asset, but no effect on net income. Let us see. No effect, no effect. What? There is no effect on net income, no effect on total asset. Okay. Let's see something. During the year, the company wrote off a customer's account receivable. The company recognizes credit losses according to the current expected credit loss model. What impact would the write-off have on net income and total assets? Would it increase, decrease, or no effect? This is a classic CPA question. The key is to recognize the trigger words. The company recognizes credit losses according to the current expected credit loss model. That tells you the expense has already been recognized. Now look at the next trigger. Wrote off a customer's account receivable. Your CPA translation should be write off, no new expense. Yeah. Journal entry, debit allowance for credit losses, credit accounts receivable. Notice what happened. Accounts receivable goes down. Allowance for credit losses go down. Since both decrease by the same amount, net accounts receivable stays the same. Example, before write-off, accounts receivable was $100,000, allowance $5,000. Net receivable was $95,000. After write-off of $1,000 accounts receivable goes down $99,000, allowance $4,000, net receivable is $95,000. Still, nothing changed. Therefore, net income no effect. The credit loss expense was recorded earlier under current expected credit loss. Total asset no effect. Net account receivable remains the same. Okay. Shortcut. Whenever you see current expected credit loss, allowance method, write-off, your brain should immediately think no effect on net income, no effect on total asset. Okay, no effect on net income, no effect on total asset. But I need to understand that really, because it says this is okay. The company recognizes credit losses according to the current expected credit loss model. That tells you the expense has already been recognized. The expense has been recognized. All right. I need to understand this clearer. So let's analyze or dissect the statements, the question, to understand phrase by phrase what they mean. Okay, the exam writers hide the accounting inside the English. Let's dissect the question exactly as they expect you to. During the year, the company wrote off a customer's accounts receivable. Phrase 1, during the year. Ask yourself, is this telling me to calculate something? No. This phrase only tells you when the event happened. Translation, ignore it. It's just timing. The company, does this matter? Not really. Okay. It's simply identifying who is performing the action. I understand that. Ignore it. Wrote off. Okay, wrote off. This is the first phrase that matters. Whenever you see write off or wrote off, you see written off, your brain should immediately ask, how do companies write off receivables? There are only two possibilities. Method 1, not used on the CPA anymore. Okay, not used on the CPA anymore. Method 1, direct write-off method. Expense is recorded today. Method 2, used on the CPA, allowance method, the CECL. Okay, current expected credit loss. Expense was recorded earlier. So don't answer yet. Wait. Expense was recorded earlier, so don't answer yet. Just recognize. Write-off tells me which transaction occurred. Does this matter? No. Okay, well, let's go then. It simply means one customer. Okay, yeah. Accounts receivable. Now we know exactly what was written off. Not inventory, not cash, not notes receivable. It was accounts receivable. Now your brain should picture the journal entry. But wait, we still don't know which method. That is why the next sentence is so important. The company recognizes credit losses according to the current expected credit loss model. This sentence is the key. Let's break it apart. Recognizes mean records, nothing more. Credit losses mean money customers are expected not to pay. Okay, credit loss is money customers are expected not to pay. It is a loss. Think bad debt. According to means using the accounting method, the current expected credit loss model. This is the biggest clue. The CPA is saying we are using the allowance method. Immediately think expense already recorded. Allowance already exists. That one sentence completely changes the answer. Now combine both sentences. Sentence 1, the company wrote off a customer's receivable. Now your brain, okay, a write-off happened. Sentence 2, they use the current expected credit loss. Your brain, excellent. That means they already estimated the loss. Now you know the journal entry. Debit allowance for credit losses. Credit accounts receivable. Now the question asks, what impact would the write-off have on net income and total asset? Okay. And debit allowance for credit losses. When you write something off, you are taking it from allowance for credit loss. Okay, so I believe what I'm trying to understand is when you write something off. When you write it off, you take it from allowance for credit loss. From the allowance for credit loss, you write it off. I understand you debit allowance for credit loss because it's not there anymore. Why would you credit accounts receivable? Would that account be transferred to accounts receivable? Okay. Uh, the missing piece is what accounts receivable actually represents. Let's walk through it. Step 1. Before the write-off, suppose customer John owes you $1,000. Your books show accounts receivable $100,000. This includes John's $1,000. Allowance for credit losses $5,000. The allowance is not John's account. It is simply your estimate that out of $100,000 owed by customers, about $5,000 won't be collected. Think of it this way. Accounts receivable equals list of customers who owe you money. John $1,000, Mary $2,000, David $500. Example. Allowance, a bucket of estimated losses. The allowance does not belong to John, Mary, or David individually. It does not belong to any of them. Step 2. What happens when John definitely won't pay? Now you know John's $1,000 is worthless. Ask yourself, does John still owe the company an asset? No. So should John's $1,000 still be listed in accounts receivable? No. You must remove John's account from accounts receivable. That's right. How do you remove an asset? Credit accounts receivable. Why? That's why you credit accounts receivable. How do you remove an asset you credit? I thought you would debit, but you credit accounts receivable. You're saying John is no longer one of our receivables. Step 3. Why debit the allowance? Remember why you created the allowance months ago. Earlier you said, we expect some customers won't pay. So you already set aside $5,000 for future losses. Now John became one of those losses. You're simply using part of that reserved. It's like having a warranty reserve. You estimated warranty costs before customers return products. When someone actually returns a product, you don't record a new warranty expense. Okay? You use the reserve. The same idea applies here. Think of it like an emergency fund. Imagine you save $5,000 in an emergency fund because you expect your car might need repairs. Months later, your transmission fails and costs $1,000. Do you create a new expense at that moment? No. You pay it from the emergency fund. The emergency fund decreases by $1,000. That's exactly what the allowance for credit losses is. An emergency fund for bad debts. So the journal entry is saying debit allowance for credit losses $1,000. Use $1,000 of the reserve we already created. Credit accounts receivable $1,000. Remove John's account because he no longer owes us anything we expect to collect. The key realization you ask, would that account be transferred to accounts receivable? Actually, it's the opposite. The account is being removed from accounts receivable before the write-off. Yes, accounts receivable. Okay. I understand that, but debit the allowance because you're using the reserve. Credit accounts receivable because you're removing a customer who no longer represents a collectible asset. Credit. I believe I'm not understanding why would you credit accounts receivable if you are removing an account. I believe if you're removing an account, you debit. How do you explain that? Removing something means debit, but in accounting, you don't debit or credit because you're adding or removing something. You debit or credit based on the normal balance of the account. Let's go back to the beginning. Step 1, how was accounts receivable created? Suppose you sell merchandise on credit for $1,000. Journal entry, debit accounts receivable $1,000. Credit sales revenue $1,000. Ask yourself, why did we debit accounts receivable? Debit accounts receivable. Because accounts receivable is an asset, and assets increase with debits. Now the T account looks like this. Accounts receivable, debit $1,000, credit, balance is $1,000, debit. John does not pay. Now John's $1,000 is worthless. Should accounts receivable still show $1,000? No. It should become zero. How do you take a debit balance back to zero? You must credit it. Look at the T account. Accounts receivable, debit $1,000, credit $1,000, balance zero. Nothing mysterious happened. You're simply undoing the original debit. Here is the rule that will help you throughout accounting. Every account has a normal balance. Assets, debit balance. Liabilities, credit balance. Equity, credit balance. Revenue, credit balance. Expenses, debit balance. When you want to decrease an account, you use the opposite side of its normal balance. So to decrease an asset, credit it. To decrease the liability, debit it. To decrease an asset, credit the asset. To decrease an asset, credit the asset. To decrease the liability, debit. Okay, imagine your checking account has $1,000. If you withdraw $1,000, are you adding money? No. You're reducing the balance. In accounting, accounts receivable works the same way. It already has a debit balance. To reduce that balance, you post a credit. I'm removing it, so I could debit it. Think, what type of account is this? Accounts receivable is an asset. Asset increase with debits. Therefore, assets decrease with credits. That's the only rule you need. Okay, it's a rule, but I need to understand what's behind it, like debit. I know there is a rule. I understand the rule. Okay, now, where is this idea coming from? Debit and credit. Let's say I have $1,000 in my checking account. In that checking account, there is $1,000. If I am removing $500 out of that $1,000, am I crediting or am I debiting? Question 1? Question 1 should be simple. Okay, this is actually where many accounting students get confused because there are two different perspectives. Your perspective, your books. The bank's perspective, the bank's books. Let's separate them. From your perspective, suppose your company has $1,000 in cash. Cash is an asset. The cash account looks like cash, debit $1,000. Now you spend $500. Your cash accounts becomes debit $1,000, credit $500, balance $500. So on your books, spending $500 means credit cash $500. Why? Because cash is an asset, and assets decrease with credits. From the bank's perspective, the bank owes you $1,000. To the bank, your deposit is their liability. Liabilities have a normal credit balance. When you withdraw $500, the bank now owes you only $500. So the bank records debit, its liability, your deposit account, $500. That's why your bank statement may use the word debit and credit differently than you do. Where did the idea of debit and credit come from? This is the deeper question. The words debit and credit do not mean add and subtract. They simply mean debit, left side of a T account, credit, right side of a T account. Whether the balance goes up or down depends on the type of account. Foreign asset, debit, increase, credit, decrease. For a liability, debit, decrease, credit, increase. So when you ask, if I take $500 out of my checking account, am I debiting or crediting? The answer, on your books, you credit cash because cash is your asset. You credit cash because cash is your asset. On the bank's books, they debit deposits payable because your account is their liability. Okay, I don't think you're struggling with the rule. I think you're asking why did accountants decide assets increase on the debit side instead of the credit side. Okay, that's a fantastic question, and it's rooted in the history of double entry bookkeeping developed during the Renaissance, particularly by Luca Pacioli. The choice was essentially a convention. Accounts could have defined asset to increase on the right and liabilities on the left, but once the convention was established, everything else was built around it. The important thing is that the system is internally consistent. Assets and expenses have debit normal balances. Liabilities, equity, and revenue have credit normal balances. Every transaction keeps the accounting equation in balance. So the reason you credit accounts receivable when writing it off is not because credit means remove. It's because accounts receivable is an asset, and in this accounting convention, the right side credit is the side that decreases. That decreases asset. Once you see debit and credit as left and right rather than plus and minus, the journal entry becomes much more logical. Okay. Okay. Well, I think I need some more perspective on that. Writing off an account receivable, allowance for credit loss goes down contra asset account. Accounts receivable goes down, which is an asset. Both accounts are reported under assets. Therefore, the amount offset resulting in no change to total assets. Okay. Accounts receivable goes down. Allowance for credit loss goes down. Allowance for credit loss goes down 1,000. To contra asset, accounts receivable goes down. Okay. GAAP requires current expected credit loss model to be used when accounting for credit losses or bad debts, rather. Losses, bad debt, rather than reducing the accounts receivable directly. Expected credit losses. Wait. Okay. Expected credit losses accumulate in the allowance for credit losses. A contra account. The allowance is adjusted on each reporting date. So the net carrying value of the accounts receivable equals what management expects to collect due to credit loss. All right, let me move forward. Let me get another question. I may understand that later. The following information pertains to Eagle Co's year 3 sales. Cash sales, the gross is $80,000. Returns on allowances $4,000. Credit sales, gross $120,000. Discounts $6,000. On January 1st, year 3, customers owed Eagle $40,000. On December 31st, year 3, customers owed Eagle $30,000. No accounts receivable were written off, and no credit losses were recorded in year 3. Under the cash basis of accounting, what amount of net sales revenue should Eagle report for year 3? Under the cash basis, not accrual basis. Cash basis. What amount of net sales? Net sales revenue. Okay. Cash sales is what's gonna be, yeah. Gross is 80,000. Credit sales is gross, yeah. On January 1st, the Farm Eagle year 3. January 1st, year 3, customer owed Eagle $40,000. In December 31st, year 3, customer owed Eagle $30,000. Okay, so they paid. So now let me see something. Credit sales $120,000. Credit sales $120,000. You have $80,000. 120 minus 80. That's 40,000. This is where we find the $40,000. They owe them, okay, at the beginning of the year. At the end of the year, they only owe them $30,000. Did they make new sales? I don't know if they made new sales, but they only owe them $30,000 now. So there is a $10,000 that was paid. They paid them $30,000. So gross revenue is $90,000 in this case. What amount net sales? Net sales would be gross revenue minus returns and allowances. So 90,000 minus 4,000, that would be $86,000 if I'm right. No way. Something else happens here. I don't know what happened, but let me. Let's solve this one way. Okay. Step 1, identify the keywords. The most important phrase is under the cash basis of accounting. Yes, we're talking about cash basis. Your brain should immediately translate this to only counts cash actually received from customers this year. Yes. Cash received $80,000. Your brain should immediately, okay, only count cash actually received from customers this year. Ignore when the sale was made. Focus on cash collected. Okay. Step 2, cash sales. Gross cash sales $80,000. Less returns and allowances $4,000. That's $76,000. Net cash sales $76,000. This money was collected immediately, so it all counts under the cash basis. Step 3, credit sales. Gross sales $120,000. Oh, okay, wait. Less discount $6,000. That's $114,000. But wait, under the cash basis, you do not record all $114,000 because not all of it was collected. Instead, determine how much cash was collected from customers. Use accounts receivable. Beginning accounts receivable $40,000. Ending accounts receivable is $30,000. What happened? Customers owed you $40,000 at the beginning of the year. By the end of the year, they owe you only $30,000. That means they paid off 40,000 minus 30. Yeah, they paid off 10,000. How old receivable of $10,000 of old receivables? Now add collections from this year's credit sales. Think of the formula. Cash collected from customers equals beginning accounts receivable plus net credit sales minus ending accounts receivable, which is cost of goods sold. No. Cost of goods sold is plus purchases. Cash collected from customers, beginning accounts receivable plus net credit sales minus ending accounts receivable. Substitute the number. And here you have 124,000. This is the cash collected from credit customers. Step 5. Total cash basis sales revenue is $76,000. 76 plus 124 is $200,000. Oh, wow. Okay. Whenever you see cash basis and they give you beginning accounts receivable, ending accounts receivable, credit sales, immediately think cash collected equals beginning accounts receivable plus net credit sales minus ending accounts receivable. This is cash collected from customers. In this problem, cash sales is $76,000. Credit collections, $124,000. Answer is $200,000. Notice another key word in the question. No accounts receivable were written off and no credit losses were recorded. That information is there to tell you there are no bad debt adjustment affecting the accounts receivable roll forward. It lets you safely use the simple collection formula without worrying about write-offs. Okay? We are getting there. 15 minutes. All right. 200,000. I would want to come back to this question. Let me see if I understand this question just by looking at it. The following information pertains to Eagle Close Year 3. Gross cash sales $80,000. Returns and allowance $4,000. Okay, for cash, we have $76,000 for cash. Okay. Cash net sales. Credit sales, we have gross $120,000. Discount $6,000. Now the net is going to be $114,000. We have beginning accounts receivable $40,000. Ending accounts receivable $30,000. No accounts receivable were written off and no credit losses were recorded in year 3. Under the cash basis of accounting, what amount of net sales revenue should Eagle report for year 3? Okay, so these are two separate accounts. We have cash account, we have credit account. But because it is credit account, that doesn't mean you will never collect that money or you did not collect the money during the year. So that's why when you see accounts receivable, don't think about cash. Cash is already cash. You already collected that money. Returns and allowance, yes, you can reduce that or subtract that, but don't think about accounts receivable when you're thinking about cash sales. In fact, accounts receivable and cash sales, they do not match, So now they give you the accounts receivable information is because of the credit sales. At the beginning of the year, they owed me $40,000. At the end of the year, they owed me $30,000. So how much did I collect from that $120,000? First of all, we need to subtract the discounts. Discounts is $6,000. So what we have as net sales is $114,000. So how much cash did you collect from customers? It's gonna be beginning accounts receivable plus net sales minus ending accounts receivable. That's the formula. Beginning accounts receivable plus net credit sales minus accounts receivable minus ending accounts receivable. That will give me how much we collected. So that's 124,000. We collected 124,000. So that means we made some more sales during the year. Okay. This is how much money we collected. It is intriguing to see that the net credit sales is $114,000, but we collected from the credit sales account $124,000. How is this possible? Excellent observation. This is actually the heart of the problem. The answer is because you collected money from 2 different years. Let's draw the timeline. Beginning of year 3, customers already owed Eagle $40,000. That $40,000 came from sales made in year 2. Okay. Not year 3. Makes sense. Year 2, and then credit sales happen. Accounts receivable equals $40,000. When year 3 begins, you already have customers owing you $40,000. During year 3, I see. You make new credit sales. Gross sales 120,000, less discount 6,000. Net credit sales 114,000. Now, if nobody paid anything, accounts receivable would become beginning accounts receivable $40,000, new credit sales 114,000. It would equal $154,000 for accounts receivable at the end. Customers paid during year 3. By the end of the year, accounts receivable is only $30,000. Ask yourself, what happened to the missing $124,000? It was collected. Think of accounts receivable as a bucket. Beginning accounts receivable is $40,000. Add new sales. Bucket $40,000 plus $114,000. That's $154,000. Now customers pay you. They remove the $124,000. The bucket $154 minus $124 equals $30,000. That's exactly the ending balance. Yes, that makes sense. Yeah, okay. So the formula is cash collected from customers from credit sales is beginning accounts receivable plus net credit sales minus ending accounts receivable. Okay. This is what you need to know. In its December 31st year 4 balance sheet, the company reported accounts receivable of $800,000 before allowance for credit losses of $25,000. Credit sales during year 4 or year 5 is $630,000, and collections from customers excluding recoveries of $5,000 totaled $740,000. During year 5, accounts receivable of $20,000 were written off. The company estimated that $35,000 of the accounts receivable at December 31st, year 5, was uncollectible. In its December 31st, year 5 balance sheet, what amount should the company report as accounts receivable before allowance for credit losses? Before allowance for credit losses. What amount should the company report as accounts receivable before allowance for credit losses? And it's December 31st, year 5 balance sheet. December 31st, year 4 balance sheet. The company reported accounts receivable of $800,000. So this is beginning accounts receivable before allowance for credit losses. Allowance for credit losses is $25,000. What is allowance for credit losses? This is a contra asset account. So this is the different account. Okay, allowance for credit losses. Allowance for credit loss decreases accounts receivable. Okay, so 800,000 minus 25,000. Cool. Credit sales during year 5 were $630,000, and collections from customers, excluding recoveries of $5,000, totaled $740,000 during year 5. Why could you collect $740,000 from customers if you only sold for $630,000? It's because you collected part of the $800,000 that you began the year with. That's good. That's good observation. Now, during year 5, accounts receivable of $20,000 were written off. So you have a write-off. If there is a write-off, accounts receivable will decrease by $20,000. The company estimated that $35,000 of the accounts receivable at December 31st, $35,000 will be uncollectible. Okay, and it's December 31st, year 5 balance sheet. What amount should the company report as accounts receivable before allowance for credit losses? Before allowance for credit losses. I see. Okay. So now what we need to find is ending accounts receivable. I believe this is what they are asking for. They are asking for ending accounts receivable. We still have the formula. The formula is cash collected from customer equals beginning accounts receivable plus net credit sales minus ending accounts receivable. I believe this is what we're going to be using. Let me see what we got. 3 minutes. Okay. This is a perfect CPA question because it tests whether you know what the question is asking. Before doing any math, let's identify the keywords. Step 1. What is the question asking? What amount should the company report as accounts receivable before allowance for credit losses? Okay. Translate this to CPA language. Find the ending gross accounts receivable. That's what it is. Ending gross accounts receivable. Notice the words. Before allowance, don't use the $35,000 estimate. Accounts receivable, don't calculate net realizable value. So immediately eliminate these from your thinking. Beginning allowance, $25,000, you're not using that. Estimated uncollectible, $35,000, you're not using that. Those numbers are distractors. Step 2, start with beginning accounts receivable. Beginning gross accounts receivable, $800,000. Okay, $800,000. Step 3, add new credit sales. Every credit sale increases accounts receivable. Okay, new credit sales, $630,000. That becomes $1,430,000. Step 4, subtract collections. Collections reduce accounts receivable. $1,430,000 minus No, minus 740,000 equals $690,000. Step 5, subtract write-offs. When you write off an account, you remove it from accounts receivable. 690,000 minus 220,000 equals $470,000. What about recoveries? The question says collections from customers excluding recoveries of $5,000. This phrase is very important. A recovery happens in 2 steps. Step 1, reverse the write-off. Okay, debit accounts receivable, credit allowance. Accounts receivable increased by $5,000. Step 2, customer pays. Debit cash, credit accounts receivable. Accounts receivable decreases by $5,000. The net effect on accounts receivable is 0. Yes. Since the $740,000 collection exclude recoveries, you also don't subtract the $5,000 recovery collection. The recovery increases accounts receivable and then immediately decreases it by the same amount. So the recovery has no effect on ending accounts receivable. Final answer, gross accounts receivable is $470,000. Here is the shortcut to remember. When the question asks accounts receivable before allowance, your brain should immediately write. Let me finish with this idea.
Over net credit sales.
Alright, finish with this idea. Whenever the question asks accounts receivable before allowance, your brain should immediately write ending gross accounts receivable equals beginning accounts receivable plus credit sales minus collections minus write-offs. Notice what's not in the formula. Beginning account receivable, ending accounts receivable, credit losses expense estimated uncollectible. Ending accounts receivable equals beginning accounts receivable plus credit sales minus collection minus write-offs. Okay, we'll come back to this.
365 over accounts receivable turnover. Days sales outstanding. 365 over accounts receivable turnover. Days inventory outstanding. Average inventory over cost of goods sold times 365. Days inventory outstanding. Average inventory over cost of goods sold times 365. Days inventory outstanding. Average inventory over cost of goods sold times 365. Days inventory outstanding. Ending inventory over cost of goods sold times 365. Days inventory outstanding. Ending inventory over cost of goods sold times 365. Days inventory outstanding. Ending inventory over cost of goods sold times 365. Days inventory outstanding. 365 over inventory turnover. Days inventory outstanding. 365 over inventory turnover. Days inventory outstanding. 365 over inventory turnover. Times interest earned. EBIT over interest expense. Times interest earned. EBIT over interest expense. Times interest earned. EBIT over interest expense. Accounts receivable turnover. Net credit sales over average accounts receivable. Accounts receivable turnover. Net credit sales over average accounts receivable. Accounts receivable turnover. Net credit sales over average accounts receivable. Inventory turnover. Cost of goods sold over average inventory. Inventory turnover. Cost of goods sold over average cost of goods sold. Gross profit. Sales minus cost of goods sold. Gross profit. Sales minus cost of goods sold. Return on assets. Net income over average total assets. Return on assets. Net income over average total assets. Return on assets. Net income over average total assets. Return on assets. Income over average total assets. Return on equity. Net income over average stockholders' equity. Return on equity. Net income over average stockholders' equity. Return on equity. Net income over average stockholders' equity. Debt ratio. Total liabilities over total assets. Debt ratio. Total liabilities over total assets. Debt ratio. Total liabilities over total assets. Debt to equity ratio. Total liabilities over stockholders' equity. Debt to equity ratio. Total liabilities over stockholders' equity. Current ratio. Current assets over current liability. Current ratio. Current assets over current liabilities. Current ratio. Current assets over current liabilities. Quick ratio. Cash plus marketable securities plus accounts receivable over current liabilities. Quick ratio. Cash plus marketable securities plus accounts receivable over current liabilities. Net profit margin. Net income over sales. Net profit margin. Net income over sales. Net profit margin. Net income over sales. Day sales outstanding. Day sales outstanding. Average accounts receivable over net credit sales times 365. Day sales outstanding. Average accounts receivable over net credit sales times 365. Day sales outstanding. Average accounts receivable over net credit sales times 365. Day sales outstanding. Ending accounts receivable over net credit sales times 365. Day sales outstanding. Ending accounts receivable over net credit sales times 365. Day sales outstanding. 365 over accounts receivable turnover. Day sales outstanding. 365 over accounts receivable turnover. Days inventory outstanding. Average inventory over cost of goods sold times 365. Days inventory outstanding. Average inventory over cost of goods sold times 365. Days inventory outstanding. Average inventory over cost of goods sold times 365. Days inventory outstanding. Ending inventory over cost of goods sold times 365. Days inventory outstanding. Ending inventory over cost of goods sold times 365. Days inventory outstanding. Ending inventory over cost of goods sold times 365. Days inventory outstanding. 365 over inventory turnover. Days inventory outstanding. 365 over inventory turnover. Days inventory outstanding. 365 over inventory turnover. Times interest earned. EBIT over interest expense. Times interest earned. EBIT over interest expense. Times interest earned. EBIT over interest expense. Accounts receivable turnover. Net credit sales over average accounts receivable. Accounts receivable turnover. Net credit sales over average accounts receivable. Accounts receivable turnover. Net credit sales over average accounts receivable. cost of goods sold over average inventory. Inventory turnover, cost of goods sold over average inventory. Inventory turnover, cost of goods sold over average inventory. Cost of goods sold, beginning inventory plus purchases minus ending inventory. Cost of goods sold, beginning inventory plus purchases minus ending inventory. Cost of goods sold, beginning inventory plus purchases minus ending inventory. Gross profit. Sales minus cost of goods sold. Gross profit. Sales minus cost of goods sold. Gross profit. Sales minus cost of goods sold. Return on assets. Net income over average total assets. Return on assets. Net income over average total assets. Return on assets. Net income over average total assets. Return on assets. Income over average total assets. Return on equity. Net income over average stockholders' equity. Return on equity. Net income over average stockholders' equity. Return on equity. Net income over average stockholders' equity. Debt ratio. Total liabilities over total assets. Debt ratio. Total liabilities over total assets. Debt ratio. Total liabilities over total assets. Debt to equity ratio. Total liabilities over stockholders' equity. Debt to equity ratio. Total liabilities over stockholders' equity. Current ratio. Current assets over current liability. Current ratio. Current assets over current liabilities. Current ratio. Current assets over current liabilities. Quick ratio. Cash plus marketable securities plus accounts.
We are back. Break goes by really fast. Let's get back to work. Okay. Back to work. Let me go back to this question. And it's December 31st, year 4. Balance sheet. The company reported accounts receivable of $800,000 before allowance for credit losses of $25,000. Credit sales during year 5 were $630,000, and collections from customers excluding recoveries of $5,000 total $740,000. This is collection from customers. During year 5, accounts receivable of $20,000 were written off. The company estimated that $35,000 of the accounts receivable at December 31st, year 5 was uncollectible. In its December 31st, year 5 balance sheet, what amount should the company report as accounts receivable before allowance for credit losses? In this question, the first thing we need to notice is what are they asking for? Here they are asking for ending accounts receivable. But there are some details inside of the question we need to pay attention to. They say credit sales during year 5 were $630,000 and collection from customers, excluding recoveries of $5,000 total. This is a collection from customers, $740,000. Okay. During year 5, accounts receivable of $20,000 were written off. Write-off. The company estimated that $35,000 of the accounts receivable at December 31st, year 5, was uncollectible. What amount should the company report as accounts receivable before allowance for credit losses? Before allowance for credit losses. This is really important. Accounts receivable of $20,000 were written off. $35,000 of accounts receivable was uncollectible. Okay. So you're going to exclude these from your calculation. Let's go back to the explanation of this. Okay. What is the question asking for? What amount should the company report as accounts receivable before allowance for credit losses? Find the ending gross accounts receivable. That's what they are asking. Find the ending gross accounts receivable. Notice the words before allowance. Don't use the $35,000 estimate. Accounts receivable. Don't calculate net realizable value. So immediately eliminate these from your thinking. Beginning allowance $25,000. Estimated uncollectible $35,000. Those numbers are distractors. Step 2. Start with beginning accounts receivable. Beginning gross accounts receivable is $800,000. This is what we begin the year with. Step 3. Add new credit sales. Every credit sale increases accounts receivable. Every credit sale increases accounts receivable, $800,000. That's the beginning. And then what else did we have? Credit sales during year 5, $630,000. So $800,000 plus $630,000. That's $1,430,000. Step 5, subtract collections. Collections reduces accounts receivable. Collections reduce accounts receivable. So what do we have about collection here? End collections from customers excluding recoveries of $5,000. So recovery was $5,000. We didn't count that. The collection is for $740,000. So step 5, subtract collections. Subtract collections from accounts receivable. That's correct. If you collect the money, it cannot be part of your accounts receivable anymore. So $1,430,000 minus $740,000 equals $690,000. This is accounts receivable. Step 5, subtract write-offs. When you write off an account, you remove it from accounts receivable. So why would you remove write-offs? Why would you remove write-offs? This question says collection from customers excluding. Yeah. We're not supposed to remove write-offs because we are looking for what? Let me see something. Wait a moment. Subtract write-offs. When you write off an account, you remove it from accounts receivable. 690 minus 220 equals 470. Yeah, there. Well, in this case, we were not supposed to subtract write-offs because what we're looking for in the first place is gross accounts receivable. Is gross ending accounts receivable. So why would we subtract write-offs? This is outstanding question. In fact, you're questioning one of the most important concepts in the chapter. The answer is gross accounts receivable does not mean before write-offs. It means before subtracting allowance for credit losses. Those are two completely no. Wait. The answer choices that we have are 635,000, 670,000, 675,000, $690,000. Now you will understand why we need to subtract write-off. You can't say we're not now you're gonna give me all the reasons in the world we cannot subtract write-offs. This is exactly why I wanted to see the answer choices. They tell something is off. Let's compute it again. Beginning accounts receivable is $800,000. Credit sales $630,000 equals $1,490,000. Collections for $740,000 equals $690,000. Now comes the question, should we subtract the $220,000 write-offs? From an accounting standpoint, yes. A write-off credit accounts receivable. Yes, a write-off credits accounts receivable. So it reduces the gross accounts receivable balance. That would give 690 minus 220 equals 470. But 470 is not one of the answer choices. That tells us one of two things is true. The problem statement you read is missing or misstated something, or one of the numbers was read incorrectly. Notice something very interesting. One of the answer choices is 690, which is exactly what you get if you do beginning accounts receivable plus credit sales minus collections and ignore the write-offs. That is not how the accounts receivable ledger normally works, because write-offs reduce accounts receivable. So if the official answer is 690, I would want to see the exact wording of the question. Okay, so let's get it. This question is taking a lot of time. All right. Now we found it. The number is 20,000, not 220,000. Now everything works perfectly. Let's solve it again. Beginning accounts receivable is $800,000. Credit sales is $630,000 equals $1,430,000. Collection $740,000 equals $690,000. Okay, minus write-offs $20,000. That equals $670,000. So the answer is $670,000. Okay, minus write-offs. So let's address your conceptual question, because it is very important one. You ask, if they are asking for gross accounts receivable, why do we subtract write-offs? The key is that gross does not mean before write-offs. It means before subtracting the allowance for credit losses. Think of the balance sheet. It reports accounts receivable gross, less allowance for credit losses. Net accounts receivable. Okay. So I see. Notice where the $20,000 write-off went. It is already gone. Why? Because after a write-off, that customer is no longer receivable. Imagine this. On December 31st, you have these customers. John owes you $200. Mary owes you $300. David owes you $500. Gross accounts receivable is $1,000. Now you determine John is bankrupt and write off his account. Should the balance sheet still say customers owe us $1,000? No, John no longer owes an amount that qualifies as an asset. The list becomes Mary $300, David $500, which is $800. Only after you determine gross accounts receivable do you estimate that perhaps David won't pay all his balance. That estimate becomes the allowance. Here is the sentence I want you to remember forever. A write-off removes a customer. A write-off removes the customer from accounts receivable. An allowance does not remove the customer. It only estimates future losses. That's the difference. Write-off, the customer disappears from accounts receivable. Allowance, the customer stays in accounts receivable, but you reduce the reported value with a contra asset. Okay. Did you understand this? Did you understand? It's not too difficult. It seems like I'm kind of tired. Not difficult. What amount should the company report as accounts receivable before allowance for credit losses? Before allowance for credit losses. So you ignore allowance for credit losses. We'll get it. Don't worry. We will get it. Okay. Our next question. The company determined that the net value of its accounts receivable at December 31st, year 3, based on an aging of the receivables, was $325,000. Additional information is as follows. Allowance for credit losses at January 1st, year 3 is $30,000. Uncollectible accounts written off during year 3, $18,000. Uncollectible accounts recovered during year 3, $2,000. Accounts receivable at December 31st, year 3, $350,000. For year 3, what would be the company's credit loss expense? Now we need the credit loss expense. Credit loss expense. The company determined that the net value of its accounts receivable at December 31st, year 3, based on an aging of the receivables, was $325,000. Additional information is as follows. Allowance for credit losses. What would the company's credit loss expense? What is the credit loss expense? So how much credit loss are you expecting? Based on a allowance for credit loss, $30,000. Uncollectible accounts written off during year 3, $18,000. Uncollectible accounts receivable recovered during year 3, $2,000. Accounts receivable at December 31st, year 3 is $350,000. What would the company's credit loss expense be? Credit loss expense. The question teaches the other half of trade receivables. The previous question rolled forward accounts receivable. This one rolls forward the allowance for credit losses. This is a completely different account. Let's dissect it. Step 1. What is the question asking? For year 3, what would be the company's credit loss expense? Your brain should immediately think, I need to find the adjusting entry to the allowance account. Not accounts receivable. Not the realizable value. Allowance. Step 2. Determine the required ending allowance. The question says net value of accounts receivable equals $325,000. This means net realizable value is $325,000. It also gives accounts receivable equals $350,000. So ask, how much allowance is needed? Accounts receivable $350,000 less allowance for credit losses, net realizable value is $325,000. So that would be $25,000. Required ending allowance is $25,000. $350 minus $325. So your target ending balance is allowance equals $25,000 credit. Step 3, roll forward the allowance account. Now forget about accounts receivable. Draw only the allowance T account. For credit loss, write-offs $18,000. Credit beginning 30 recoveries credit loss. Wait. Now ask yourself, what balance do I need at the end? $25,000 credit. Let's do the math. Credits already in the account. Beginning allowance is $30,000. Recovery is $2,000. That's total credits, $32,000. Debits, write-offs, $18,000. Balance before adjustment, $14,000. Credit, but we need $25,000. How much more credit do we need? $11,000. Where does that come from? Credit loss expense. Okay. $11,000 we need. All right, so this question, let's make it simple. What do I need? What do I have? How do I find what I need? What do I need? What do I have? How do I get from what I have to what I need? Step 1. What do I need? The question asks for year 3. What is credit loss expense? So write down, I need credit loss expense. Nothing else. Step 2. What do I have? Now scan the questions. I have beginning allowance $30,000. Write-offs $18,000. Recoveries $2,000. Ending accounts receivable $350,000. Net realizable value $325,000. Step 3. Which of these numbers actually help me? Can I calculate credit loss expense directly? No, so I need another number. What number? Ending allowance. Step 4. Can I find ending allowance? Yes. The question gives accounts receivable $350,000, net realizable value $325,000. Think accounts receivable minus allowance equals net. Therefore, $350,000 minus $325,000 equals $25,000. Now I know ending allowance is $25,000. Step 5. Now ask again, what do I need? I need credit loss expense. What do I have? I have beginning allowance $30,000, ending allowance $25,000, write-off, recoveries. Now I have everything. Step 6. Roll forward the allowance. Beginning allowance is $30,000 minus write-offs $18,000 plus recoveries $2,000 plus credit loss expense. Ending allowance $25,000 before the adjustment. $30,000 minus $18,000 plus $2,000 equals $14,000. But I need $25,000. How much do I need to add? $11,000. That's the credit loss expense. Okay. What? I don't understand here. Which of these numbers actually help me? Okay. What would be the credit loss expense? Is there any formula I need to know? well, I would say basic formula or foundational formula that I need to know for this chapter. Foundation formula number 1, the most important net realizable value. Accounts receivable minus allowance for credit losses equals net realizable value. Or rearrange, allowance equals accounts receivable minus net realizable value. Accounts receivable equals net realizable value plus allowance. This is probably the number 1 formula in the chapter. Foundation formula number 2. Accounts receivable roll forward. This tells you the ending gross accounts receivable. Beginning accounts receivable plus credit sales minus collections minus write-offs plus recoveries reinstatements equals ending accounts receivable. Beginning accounts receivable plus credit sales minus collections minus write-offs plus recoveries equals ending accounts receivable. This formula answers questions like, what is ending accounts receivable? What is gross accounts receivable? How much cash was collected? Foundation formula 3. Allowance roll forward. This tells you the ending allowance for credit losses. Beginning allowance minus write-offs plus recoveries plus credit losses or credit loss expense equals ending allowance. Okay, allowance roll forward. This tells you the ending allowance for credit losses. Beginning allowance minus write-offs plus recoveries plus credit losses plus credit loss expense equals equals ending allowance. This formula answers credit loss expense, ending allowance, beginning allowance. This is probably the second most tested formula. Let me read it again then. Allowance roll forward. This tells you the ending allowance for credit losses. Beginning allowance minus write-offs plus recoveries plus credit loss expense equals ending allowance. Beginning allowance minus write-offs plus recoveries plus credit loss expense equals ending allowance. This formula answers credit loss expense, ending allowance, beginning allowance. This is probably the second most tested formula. Foundation formula 4. Cash collected from customers. Beginning accounts receivable plus net credit sales minus ending accounts receivable equals cash collected. Cash collected from customers, beginning accounts receivable plus net credit sales minus ending accounts receivable equals cash collected. This is used on cash basis questions, statement of cash flows, revenue questions. So it's a lot of them. Okay. Foundation formula 5. Receivable turnover. Net credit sales divided by average accounts receivable. measures how fast customers pay. Foundation Formula 6, day sales outstanding. I have this already. But here's something even more important. I don't think formulas are what you're really looking for. From studying with you, I've noticed your brain works better with foundational equations. There are really only two questions you need. Equation 1, accounts receivable, beginning plus sales. Beginning plus sales minus collections minus write-offs plus recoveries equals ending. Okay? Beginning accounts receivable plus sales minus collections minus write-offs, collections minus write-offs plus recoveries. Okay, we're talking about accounts receivable. Beginning accounts receivable minus plus sales. Okay, when you make credit sales, I would say plus credit sales. Credit sales will be added to beginning accounts receivable. Minus collection, when you collect the money, you remove that from accounts receivable. Minus write-offs, when you write off an account, you remove it from accounts receivable. Plus recoveries, when you recover an account, you add it to accounts receivable. But guess what? If you recover and you collect the cash, it will be removed from accounts receivable. That will give you ending accounts receivable. Whenever the question asks about accounts receivable, use this. Equation 2. Allowance. Beginning allowance minus write-offs. You have the allowance for credit loss. When you write it off, you got to remove it from allowance for credit loss. Remove it from allowance minus write-off plus recoveries. When you recover an account, it will be added back to your accounts for allowance for credit losses. It will also be added back to your accounts receivable. Recoveries plus credit loss expense minus ending allowance. Whenever the question asks about credit loss expense, allowance, bad debt expense, use this one. Okay, beginning minus write-offs plus recoveries plus credit loss expense equals ending. The master equation, everything in this chapter comes back to one equation. Gross accounts receivable minus allowance for credit losses equals net realizable value. From this single equation, you can drive allowance equals accounts minus net realizable value. Accounts receivable equals net realizable value plus allowance. Net realizable value equals accounts receivable minus allowance. My recommendation for mastering trade receivable, don't memorize 20 formulas. Memorize these three master equations. Valuation, accounts receivable, allowance. Valuation, accounts receivable, receivable minus allowance equals net realizable value. Accounts receivable, you start with the beginning plus sales or plus credit sales minus collections minus write-offs plus recoveries, that will give you ending accounts receivable. Allowance. You start with the beginning allowance and then you minus write-off, subtract write-offs, plus recoveries, plus credit loss expense. That will give you ending allowance. These three equations solve about 90% of the computational questions in the trade receivable chapter. The remaining challenge is simply recognizing which equation the question is asking you to use. And that's exactly what we've been practicing with the what do I need. Okay. That's good. That's good. I'm gonna put this in a song. These questions on this Monday morning, they didn't come to play. These questions didn't come to play this morning. Ooh. Oh. Okay, let's keep going. The company has $3 million in accounts receivable recorded on its books. The company wants to convert the receivables to cash in a timelier manner than waiting the 45 days for payment as indicated on its invoices. Which of the following would alter the timing of the company's cash flows for the $3 million receivable already recorded on its books? This is factoring. Factor the receivables outstanding. If a company has accounts receivable and they want to receive their money faster, they need to factor it. Factor is when you sell your receivable to a third party. They pay you now and they collect the money. Factor. Here we have other options. Change the due date of the invoice. You cannot do that. Discount the receivable outstanding. It may not work. Demand payment from customers before the due date. You can't do that. So factor the receivables outstanding, sell the receivable to a third party. Okay. The company has the following information available for the year ended September 30th, year 2. Net income, $60,000. Beginning accounts receivable, $125,000. Ending accounts receivable, $90,000. Credit sales, $75,000. Customer accounts written off during the year, $5,000. What amount of cash did the company receive from its customers during year 2? What amount of cash did they receive? Cash collected. Cash collected from customers. You have net income of $60,000. Beginning accounts receivable is $125,000. Ending accounts receivable is $90,000. Credit sales, $75,000. I believe it is beginning accounts receivable plus credit sales minus ending accounts receivable. Would equal cash collected. Check to see if my microphone is good. All right. Let's see what we got. This is another accounts receivable roll forward question. All right. What do I need? The question asks, what amount of cash did the company receive from its customers? Right? Right. Need cash collections. What do I have? From the problem, beginning accounts receivable, ending accounts receivable, credit sales, write-offs, net income that I don't need. You ignore that. Notice something. The question is about cash collected from customers. So net income is a distractor. That's true. Which account am I rolling forward? Whenever you hear cash collected, collections, cash received from customers, think roll forward accounts receivable. Step 4, draw the accounts receivable roll forward. Beginning accounts receivable plus credit sales minus collections minus write-offs equals ending accounts receivable. Now plug in the numbers. 125,000 plus 75,000 minus collections minus 5,000, which is the credit, which is the customer, the write-offs, equals 90,000. Step 5, solve for the unknown. First add 125,000 plus 75,000 equals 200,000. Subtract the write-offs. 200,000 minus 5,000, 195. Now 195 minus collections equals 90,000. So collections equals 105,000. Beginning accounts receivable plus credit sales minus ending accounts receivable equals collections. Yes. Beginning accounts receivable plus credit sales minus ending accounts receivable equals collections. That formula works only when there are no write-offs. This problem has write-offs, so you must include them. The complete formula is collections equals beginning accounts receivable plus credit sales minus ending accounts receivable minus write-offs. Okay. That makes sense. So I need to put this, I need to clip this part. 105. Okay. All right, so last year, an entity wrote off a $3,000 accounts receivable that was deemed uncollectible. During the current year, the entity recovered $2,000 of the $3,000 accounts previously written off. All of the following statements regarding the recovery of the accounts receivable are true except one. Accounts receivable, you wrote off $3,000 accounts receivable that was deemed uncollectible, and then you recovered $2,000. What's going to happen? Well, $3,000 will be reduce the accounts receivable, and then the collection, you will have $1,000. Accounts receivable will go down $1,000. Accounts receivable balance is unchanged. It changed. It decreased. Carrying value of accounts receivable decreases. Yes. Allowance for credit losses balance increase. No. Credit loss expense decrease. Credit loss expense. Which one is not true? Which one is not true? Accounts receivable balance is unchanged. This is not true. Carrying value of accounts receivable decreases. Yes. Allowance for credit losses balance increases. Allowance for credit loss balance increases. I would say yes. I would say no. Credit loss expense decreases. All right, let me see. Accounts receivable balance is unchanged. Why would it be unchanged if you only collected $2,000? Credit expense decreases. All right, one of those questions where you don't calculate. What do I need? The question asks which statement is not true. So you need to identify the false statement. Yes. What happened? The key phrase recovered $2,000 of accounts receivable previously written off. Immediately think recovery. A recovery always has two journal entries. Step 3. Write the two journal entries. Reverse the write-offs. Okay. Debit accounts receivable, $2,000. Credit allowance for credit losses, $2,000. Effect: accounts receivable goes up, allowance goes up. Net realizable value doesn't change. Entry 2, collect the cash. Debit cash, $2,000. Credit accounts receivable, $2,000. Effect: cash goes up, accounts receivable goes down. Step 4, what's the net effect? Let's summarize. Account in effect. We have accounts receivable, no change, up 2,000, then down 2,000, no change. Okay. Allowance increases $2,000. Cash increases $2,000. Net realizable value increases $2,000. Credit loss expense, no change. Okay, credit loss expense, no change. Credit loss expense. Why there is no change in credit loss expense in this case? This is most important concept in the entire trade receivable chapter. Why doesn't credit loss expense change? The answer is because the expense already recognized last year. Let's use a timeline. Year 1, John owes you $3,000. You think John probably won't pay, so you estimate the loss. Journal entry, debit credit loss expense $3,000. Credit allowance for credit losses $3,000. What happened? Expense increased, net income decreased, allowance increased. This is the only time the expense is recognized. Later in year 1, now you know John definitely won't pay. You write off the account. Journal entry, debit allowance $3,000. Credit account receivable $3,000. Notice, did we debit credit loss expense? No. Why? Because we already recognized the expense. Year 2, surprise. John sends you $2,000. Should we recognize a negative expense? No. Why? Because the expense was not wrong. At the time you estimated the loss, based on the information you had, it was reasonable to think John would not pay. Now circumstances changed, so we simply reverse part of the write-off. Reverse part of the write-off. Notice, no expense. Okay. No expense. All right, let's move forward. The company uses financial forecast when estimating credit losses under the agent of accounts receivable method. A customer's account in the amount of $5,000 is determined to be uncollectible. What impact does the write-off have on the company's credit loss expense and working capital? Credit loss expense. When you write something off, you write off credit loss expense. You write off an account, your working capital. It has no effect on your working capital. But on your credit loss expense, on your credit loss, it increases your expense. Increase your expense. Credit loss expense, decrease. No effect, what? Decrease. No effect. On working capital? I would say there is no effect on working capital. Working capital should be separate from that. All right, what do I need? The question asks, what impact does the write-off have on credit loss expense and working capital? So we need the effect on two things. What happened? The key phrase, a customer's account is determined to be uncollectible. Translation, a write-off occurred. The other key phrase is, use the agent of accounts receivable method. Translation, allowance method. Immediately think expense was already recorded. Expense was already recorded. Step 3, write off. Write the journal entry. Debit allowance for credit loss, $5,000. Credit accounts receivable, $5,000. Now let's insert each part. Part 1, credit loss expense. Ask yourself, did we debit credit loss expense? No. We debited allowance. So credit loss expense has no effect. Part 2, working capital. Now use the definition. Working capital equals current assets minus current liabilities. Ask, did current asset change? Let's see, before the write-off, accounts receivable was $100,000, allowance $10,000, net accounts receivable is $50,000. After the write-off, accounts receivable goes down to $95,000, allowance to $5,000, net accounts receivable to $90,000. Did current asset change? No. Net accounts receivable is still $90,000. Therefore, working capital, no effect. Okay, so no effect, no effect. At year end, the company uses an aging method to evaluate its accounts receivable for credit risk and records a corresponding adjustment to recognize the credit loss expense in the income statement. The practice follows the accounting concept of consistency, going concern, matching substance over form. Year end, the company uses an aging method to evaluate its accounts receivable for credit risk and records a corresponding adjustment to recognize a credit loss expense. In the income statement, the practice follows the accounting concept of going concern, consistency, matching. Have 8 minutes. This question is testing something even more fundamental than trade receivables. It is testing why we record credit loss expense. What do I need? The question asks what accounting concept is being applied. Not a journal entry, not a formula, an accounting principle. Step 2, what happened? The company uses aging method, estimates credit losses, records credit losses expense at year end. Ask yourself, why do they record an expense before customers actually fail to pay? That's the real question. Step 3, what principle explains this? Let's think. The company made sales during the year. Some customers will never pay. Should we wait until next year to record those losses? No. Why? Because those losses belong to this year's sales. We want this year's revenue, this year's related expenses reported in the same period. That is called the matching principle. The matching principle. A company has credit sales of $20,000 on January, $30,000 in February, and $50,000 in March. The company collects 75% in the month of sale, 25% in the following month. The balance in accounts receivable on January 1st was $25,000. What amount is the balance in accounts receivable at closing on March 31st? Okay. Company has credit sales of $20,000 in January, $30,000 in February, and $50,000 in March. The company collects 75% in the month of sale. Okay. 25% in the following month. The balance in accounts receivable on January 1st was $25,000. What amount is the balance in accounts receivable at closing on March 31st? We need February and March. Whatever happens in January is closed in February. Yeah. So February, $30,000. 75% of this is collected in February. 75% of $30,000. In fact, let me do the 25%. $30,000 times 25%. $7,500 is moving to March. So in March we collect that amount, $7,500 in March. So in March we have sale for $50,000. 75% of this will be collected in March. The question asks, what amount is the balance in accounts receivable at closing on March 31st? March 31st is only 25% of 50. Yes. $12,500. That's all. Yes. Finally. That was the last question. I think I'm gonna stop it here so we don't overwhelm. We're already overwhelmed with this. So let me do this. Okay. All right, shall we only have 3 minutes left? Yep. Yeah, that's fine. All right, everybody. Thank you very much for your time. I'll see you again tomorrow. I'm gonna close this.
Day sales outstanding, average accounts receivable, over net credit sales times 365. Day sales outstanding, average accounts receivable, over net credit sales times 365. Day sales outstanding, average accounts receivable, over net credit sales times 365. Day sales outstanding, ending accounts receivable, over net credit sales times 365. Day sales outstanding, ending accounts receivable, over net credit sales times 365. Day sales outstanding, 365, over accounts receivable turnover. Day sales outstanding, 365. receivable turnover. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, ending inventory over cost of goods sold times 365. Days inventory outstanding, ending inventory over cost of goods sold times 365. Days inventory outstanding, ending inventory over cost of goods sold times 365. Days inventory outstanding, 365 over inventory turnover. Days inventory outstanding, 365 over inventory turnover. Days inventory outstanding, 365 over inventory turnover. Times interest earned, EBIT over interest expense times interest earned, EBIT over interest expense times interest earned, EBIT over interest expense. Accounts receivable turnover, net credit sales over average accounts receivable. Accounts receivable turnover, net credit sales over average accounts receivable. Accounts receivable turnover, net credit sales over average accounts receivable. Inventory turnover, cost of goods sold over average inventory. Inventory turnover, cost of goods sold over average inventory. Inventory turnover, cost of goods sold over average inventory. Cost of goods sold, beginning inventory plus purchases minus ending inventory. Cost of goods sold, beginning inventory plus purchases minus ending inventory. Cost of goods sold, beginning inventory plus purchases minus ending inventory. Gross profit, sales minus cost of goods sold. Gross profit, sales minus cost of goods sold. Gross profit, sales minus cost of goods sold. Return on assets, net income over average total assets. Return on assets, net income over average total assets. Return on assets, net income over average total assets. Return on assets, income over average total assets. Return on equity, net income over average stockholders' equity. Return on equity, net income over average stockholders' equity. Return on equity, net income over average stockholders' equity. Debt ratio, total liabilities over total assets. Debt ratio, total liabilities over total assets. Debt ratio, total liabilities over total assets. Debt to equity ratio, total liabilities over stockholders' equity. Debt to equity ratio, total liabilities over stockholders' equity. Current ratio, current assets over current liability. Current ratio, current assets over current liabilities. Current ratio, current assets over current liabilities. Quick ratio, cash plus marketable securities plus accounts receivable over current liabilities. Quick ratio, cash plus marketable securities plus accounts receivable over current liabilities. Net profit margin,